Hey taxpayers, it's Tiffany Gonzalez CPA here with the hottest topic everyone is talking about: Silicon Valley Bank's collapse. The SVB bank collapse has sent shock and panic across all Americans, not just the persons that had bank accounts there. And truthfully, it's made us all think, can we even trust the American banking system at all? SVB, even for a regional bank, was one of the largest banks in America. So what went wrong? Let's start at the beginning. SVB was founded in 1983, and it was the 16th largest bank in the US right before it collapsed. The bank specialized in financing and banking for VC-backed companies, mostly tech companies that venture capitals had invested in. Many venture capital firms and their execs also banked with SVB. According to the FDIC, at the end of 2022, this bank had $209 billion in assets. The SVB bank was the preferred bank for the tech sector because it provided financing and banking opportunities for what most traditional banks considered a high-risk sector. In fact, when the FDIC looked at their clientele, they noticed that they provide backing for up to half of all VC-backed tech and healthcare companies. So in 2020, SVB had an influx of cash related to their customers, right? Tech was up and more tech startups were starting up and more VCs were investing in tech. So that bank had the largest amount of deposits in 2020 than it's ever had. The bank invested these deposits like most banks actually do. SVB specifically invested in US Treasury and agency-backed mortgage securities, which most banks also do. But the thing here is that SVB did not have enough short-term assets to cover their short-term liabilities. In other words, they invested too heavily in the long term. So when the Fed started to hike interest rates in 2022 because of inflation, SVB's bond portfolio, which is a long-term investment, started to drop. And because this portfolio started to drop, they couldn't sell out of these positions without creating a huge loss. But because they didn't have the liquidity to meet their short-term obligation, the withdrawals that people were requesting, this is what created the crisis within SVB Bank. You see, in 2023, more and more VC capital started to dry up as the economy started to recede. More tech execs started to pull money out of SVB. So at this point, SVB freaks out and they start selling their bonds at a huge loss in order to try to meet the liquidity. But within 48 hours of selling these assets, they had literally collapsed because in addition to selling these assets, they had also announced that they needed $1.75 billion worth of capital to raise from their investors. And people literally freaked out. In fact, within 24 hours of that announcement, their stock had dropped by 60%. Now, unlike most regular banks, SVB specifically had these tech startups. And many of these tech startups have a lot more than $250,000 in their bank accounts. And so many of them were freaking out even after the FDIC stepped in and said they would cover up to $250,000 because they thought they would lose hundreds of thousands, if not millions more. And for many of these tech companies, SVB was their primary bank, their operating bank. So they were freaking out about how they were going to pay their short-term bills, including payroll for their staff. But thankfully, by Sunday, March 12th, the FDIC announced that they would cover all the deposits for this bank using the deposit insurance fund that banks typically pay on an annual basis. So ultimately, the FDIC stepped in and really saved the day. And what we're seeing now is that many of these tech companies, when they finally get a hold of their cash from the FDIC, are moving to much larger banks like Chase and Bank of America. But this event has actually caused a tidal wave in the banking industry. And we're seeing that more and more people are scared of banking with regional banks now. And more people are reducing the amount they have in any given bank in order to make sure that they're under the $250,000 FDIC insurance. Ultimately, I still don't think we've seen the total damage this has yet caused. And in the coming days, weeks, and months, we'll find out more. So what do you think about what happened? Do you think it could have been avoided? What do you think about management making those decisions that led to this collapse? Chat with us in the comments below. We love hearing from you. In the meantime, hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.